burning. That's quite funny. And then you've also got Israel burning. But everything is normal. This is just nothing to look at. Just everything's upside down. Blah 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 blah. But really, the banks are perfectly safe. There's no kind of problems with society. Everything is A-OK.
Well, A-OK it is here at the Daily Energy Markets podcast. Hopefully, Omar hasn't used up all of his sound bites before 10:30 UAE time, and we will have a few left over. We have Brent crude oil trading this morning, Monday morning in Asia, a little bit up, despite all the drama. As we come to the end of the first quarter, Brent crude oil has averaged year to date through the first quarter at a little above $81 a barrel, although trading well below that at the moment. But nonetheless, we look at the averages here, and certainly the oil producers do. How much are we making over the average of time? And so far this year, oil producers in relevance to Brent at $81 plus a barrel. Where will it go in second quarter? That's certainly a question. Let's kick off with Omar Najia, Global Head of Derivatives at BB Energy. Omar, your thoughts this Monday morning? Inevitably, headlines over the weekend might be tactical nuclear weapons moving into Belarus from the Ukraine story. Elsewhere, there's Germany now moving into strikes. Europe's biggest economy now seems this contagion, not a contagion of banking crisis, but a contagion of national strikes, with transport now disrupted also in Germany. Your thoughts, Omar, this morning? You said last time we talked, at least, that it would break lower. It has.
We're bearish. So I think if you believe that sentiment and mood is what drives markets, and I certainly believe that that's true, you've got to get, basically, when you get negative moods, when you start seeing Paris on fire, so you're sitting at a cafe and you haven't ordered any crepe Suzettes, and all of a sudden you see like flames popping up, then you know that something is really wrong with the economy. I don't think you need to look far. So the same is happening in the UK. You had massive strikes. Germany is next, and you've seen what's happening in Israel. So it's kicking off everywhere. And I think the stuff that we heard about the banks and how people basically just they wheel them out and they just say, look, don't worry, that's it, that's it, that's the soundbite that you get. Everything is okay, and there's nothing else. And then you have Yellen coming and saying, we're looking at a way to guarantee all deposits in the US, all 18 trillion of them, where they have enough basically money for about 125 billion, which means a massive amount of printing. It's getting a bit to be like, binary. You either believe in the zero or you believe in the one. And we believe in the zero much more than we believe in the one. I think it's looking a bit ominous here. House prices. I think it's all looking a bit toppy, a bit ominous. Oil, you saw. There's not a lot to be kind of confident at. This banking stuff, I'm sure, is going to run. If you look at the banking, if you look at like an ETF of banks, European banks, that looks like it has a lot lower to go, which means basically, I'm not saying it's going to go to zero, but I'm saying there's going to be, more pressure that's going to come. I don't know if it's Deutsche Bank. I don't know if it's another bank. I don't know if it's the US. I was saying before we started, there was an article in Fortune magazine saying that US banks have $1.7 trillion in unrealized losses. That's a lot of money. So I'm not bullish. I'm not looking to buy anything. I've said for a while, if markets go up enough for me to get out of the stuff that I have, personally, I would. They haven't, or I got out of a little bit, but if I could get out of all the rest, I would do it. I'm not looking to buy. I don't want to buy the dip. I just want to get out. So we see what happens, but I'm negative.
Bora Barryman, managing partner, Hormuz Straits Partnership, is delighted this morning for no other reason that it's not as early as it usually is when he joins our call, because the clock came forward in the UK at 7:30. This I think it's instead of 3 hours now, it's 4 hours with the UAE after this weekend. But Bora, coming back to the banking crisis that is obviously dominating Omar's comments and has been dominating the markets now for, I think it's 2 weeks or so since the SVB crisis. My question, and obviously with that, the oil price has sort of broken down $10. We were in this 80-85 range. We're now in the 70-75 range. So it is important to keep looking at this banking crisis. And so my question to you, Bora, as a banker and a career banker with, have we identified a consistent narrative as to what has triggered this banking crisis? Is there a consistent narrative that one can identify and that the Fed has identified and so can now tackle and plug that hole? Or are we still looking for the hole in the Swiss cheese?
Well, fundamentally, we have to come to grips with the fact that we have a piece of Swiss cheese, so it comes with the holes. There's no way to get around that. In my mind, money will continue to flow out of banks when, we see short-term 2-year U.S. Treasuries paying 4% and banks paying 0 on current accounts. And we see that inflation, we all agree now, is not transitory. So the money is seeking better yields and safety, which is not being offered by the banks. Clearly, the market signal is that investors don't feel comfortable with their money sitting in these banks. And unfortunately, this is due to the fact that the banks have been crowded out in their competition for capital by their own governments and the Fed, which sits on top of the international monetary architecture. And the only place that the banks have been able to go for liquidity is back to the Fed via this discount window, which has injected 300 billion into the system. And that 300 billion injected into the system over the past couple of weeks is from that magic printer called the Fed balance sheet. So, in my mind, this is just the culmination of 15 years of this free money policy that has really distorted the architecture of the world economy. And that structure is no longer sound. So looking, at the analogy with what's happened in Turkey, you can assess that the structure is not sound. A new architecture needs to be put into place, but the tenants have to relocate while a new paradigm is rebuilt. But the sad news is we haven't agreed on that process, on what type of new paradigm we are going to build. And the tenants are still residing in the same architecture with the risk that an earthquake comes and collapses the structure. And hence we have this volatility and uncertainty that will persist for some time.
Let's welcome Bill Spindle, former Council on Foreign Relations, International Affairs Fellow in India and Asian correspondent with the Wall Street Journal, amongst many other significant career positions, Bill, and a lot of it in Asia. And that's where I wanted to take the narrative, because where there is a sort of green shoots, if you like, or positive demand outlooks for energy, we had the head of the IMF over the weekend in China at a conference saying that the risks to the financial stability have increased, but green shoots are appearing. And in India, we see continued very strong economic growth, a significant oil importer in Asia. So generally, the Asian narrative does seem to be while concerned, but still positive and moving forward as compared to the European American axis at the moment, which is where all these bad headlines are from. Where do you think India and Asia's ability will be to continue to move and defy this downward draft that we're seeing in the West?
Yeah, I think it will continue to grow pretty steadily. India, maybe at the higher end of expectations. China, maybe at the lower end of expectations. I think they're talking about a little over 5% growth. So they'll probably come in right around that level. But yes, it's not, it's growing. But in China, particularly, you're not seeing the sort of really robust bounce back from COVID that many expected to see. So you've got that Asian demand that's going to be balanced with whatever happens sort of in the US and Europe. And so much of that, as we've just heard, depends on how this banking stuff plays out. Does it play out in a rapid kind of real banking crisis in the short term, or is it a longer term drag, as we just heard, sort of as you begin to sort of shift the banking system to adjust to a higher interest rate environment and to a different kind of technology environment, really. And that's going to be the balance. It's pretty hard to predict, and it's especially hard to predict really over the next week or two as we deal with these very psychological fears about a banking crisis. I think we saw they've lined up a buyer for Silicon Valley Bank just before the European markets opened. I think everybody expected that to happen, but it at least is a tidbit of positive news to try to keep the sentiment positive going through this next couple trading days, because that's really what, the great danger here in the short term is that we see another bank or two, small, mid-sized bank in the US go under, and these fears really spread rapidly, and that really causes a huge short-term problem, not a full-blown 2008 financial crisis, but a significant enough problem that you'd see a sharp cutback in lending and then the Fed's in an even trickier situation than it's in now.
Omar, I mean, despite all of the drama, hence my sort of opening point, the markets are still relatively sober. Brent has averaged $81 so far this year. It's a very nice sort of equilibrium price, although it's down $5 at the moment, in the mid 70s, still a very acceptable price for consumers and producers. The equity markets still trading in, relatively sober territory. Where is the drama reflected in the money in the money, if you like, in the markets, which is sort of the reflection of the trauma? We're not seeing that in the markets. Omar's on mute. He should never be on mute. He's putting him self-censorship, Omar. Come on.
So basically, look, I think you're not seeing it on a closing basis. You're seeing it intraday, right? So oil prices moved massively. The S&P moved massively. The equity markets in Europe moved massively. But I think what's important to understand is, I think you can say that everything is okay, like they've been saying, before we moved down and before there was the banking stuff.
What I'm saying, we're not reflecting it in the markets, right? In the what are the sort of point in which all of the collation of all of this drama is meant to be, we look to the markets as the sort of interpretation, the filter of that.
Because basically what I think is going to happen is that, the market is going to reflect it at some point. But right now you have, a lot of kind of complacency that, the Fed can fix everything. You're going to find a buyer. You find a buyer for Credit Suisse, you're going to find a buyer for SVB, and everything's going to be okay. But I think the issues in the market, especially in, the financial markets, are systemic. So, the banking crisis is just one reflection. I think next one to kind of come is going to be corporate bonds, right? So the bond market now, it gets very detailed. A lot of people got hurt in Credit Suisse with these AT1 bonds and all this kind of stuff that were basically, they shouldn't have been penalized, and they shouldn't have lost all their money, but nevertheless, they changed the law and they made it. So, but bottom line is, I think bonds are going to be next. corporate bonds are basically, going to be the next kind of issue that we have. Interest rates, I don't think are going to come down anytime soon. The Fed doesn't know what to do. Higher interest rates, at a time when you have all-time highs in debt, government, corporate, consumer, all this kind of stuff. So it's all going to come home. But what you need to understand is what happens when it comes home, when it's reflected in markets, is going to be basically a panic. So right now, you're basically seeing everybody looking at each other. Fire alarm goes, they look at each other, they look at the exit, they look at each other. You see that reflected. Then all of a sudden, the fire alarm stops and they sit back down at their desks again. But sooner, I think, rather than later, that fire alarm is going to keep going, and that's when you're going to see people heading for the exits en masse. And you're going to see the trampled and 100 people trying to go through a door that's big enough for one person. So I think it's all coming. I think you can see it politically. I think you can see it. I think you can, there's a real sense of a rudderless kind of stuff, right? I mean, if you go back to the beginning of this year, it was supposed to be, or the beginning of last year, it was supposed to be, we are the West, we are the great, we are going to absolutely destroy anything to do with the Russian economy, bring them to its knees, and forward a year and a bit, and guess who's on their knees? And people still have like a kind of a denial of that, right? So you're still spending money hand over fist. I think the IMF sent like 15 billion the last week to Ukraine. They've given them, the West has given them like 150, 200 billion. There's still more. Biden, says we're going to do this, we're going to do that. Now you have the banking crisis. Next, you're going to have the bond crisis. And I think, it's up a creek without a paddle. So I think you're going to see the panic. It's just right now, the fire alarm has stopped and they're all sat down again.
Bora, I mean, the fire alarm has stopped. A lot of the recent drama, I mean, it has been is looking prior to that, looking beyond it, this banking crisis sort of headline grabbing drama, is the trends were already embedded, right? For months, 6 months ago, we were waiting for this recession to come and for demand in the West to soften. Although we now still have kind of full employment in the US and even in the UK, which is supposed to be, the unwanted child of the G7. And then we had the counter narrative of China and India was always for months going to be the sort of the second half of the year savior to the demands narrative, and the second half of the year savior, China hasn't quite shown its demand teeth yet, and the West hasn't quite, it's this slowdown. The interest rates keep going up. The impact on economic health, its intended impact to slow down the juggernaut of the G7 economies is happening, but and is happening maybe a little bit quicker now. But these are all narratives were already embedded. My point is, and that this banking wobble has just sort of played a part in it, but these are narratives that are already underway, and the banking crisis may accelerate. I mean, nothing to look at here, essentially.
Yeah, I don't know. Did you have a question there?
Well, that's my point. Is anything changed? That there's anything that this banking crisis certainly has turned up a lot of headlines, but it hasn't changed a direction of travel that was already bedded in. The fastest growing interest rate, over a year, slowdown that was to come, recession now still being forecast. I mean, nothing has changed. This banking crisis hasn't changed anything. That's my point, except distract us from that narrative that was already bedded in.
Look, the situation today just reminds me of the 60s and 70s, let's say the mid 70s, where at that time the world economy was massively dominated by the United States, which had gone out on guns and butter. The welfare state expanding, all these federal departments that we see today were set up in that period by the Nixon administration, and a massive war in Southeast Asia, which really polarized the Western world and remade it into something that it wasn't before. And there was an economic consequence of that. The breakdown of the Bretton Woods system, the depeg from a dollar being worth a certain amount of gold, and an inflation that was a result of basically that spending, and a stagflation when the authorities were not able to sustain that ever rising period of happiness, right? Free money. So and we know how it ended. Actually, we know what
and
is
you're saying that this is a comparable window to the 70s, the OPEC embargo, the
for the West. For the West, I say it's comparable.
Really?
Because we know what the cure to that.
And yet you said we're not in 2008-09 territory.
I mean, look, I think we have a lot more to run on inflation because we don't have a Volcker moment, but we know what the cure to this situation is. It's a massive downgrade in living standards that we're trying to postpone, right? Because we've had it too good. What's different here is Asia is very different. Asia was nothing in the 70s and it wasn't a factor at all. And now it is a whole different compartment because we've deglobalized. You know, India is not growing on the basis of all these capital inflows from America or Europe. They're growing on their own dynamics, and same as China. And
they love Mercedes like anybody else. I'm sure the Indians will be, purchasing all of those amazing goods. In essence, that narrative of 70s comparison is a big call at this moment, it seems to me, although there are ingredients, I'm not saying there aren't, but that we would be cautious of crying wolf a little bit. Bill, I wanted to get your thoughts on another part of this story that, taking from Bora's point there, comparable shifts of gravity. In all of this, there are signs of geopolitical shifts, and now we're seeing the Gulf turn to China, the Saudi in Iran rapprochement curated by Beijing. Do you see that as a comparable shift of scale, like Bora's pointing to in the 70s from the point of view of the economic shift there? Are we seeing a geopolitical shift, tectonic plates?
Yeah, I think it follows from it in some ways. You've got, I think what you're saying is the saying used to be that when America catches a cold, the rest of the world gets a fever. Now, I think you'd say that America would have to get a fever before the rest of the world started to really feel, or particularly Asia would really start to feel the pinch. The problem is the other big difference, I think, that this last couple of weeks has seen is the Fed's in a much trickier position that really could put the U.S. potentially into a fever. If I can switch the analogies on you a little bit, I think the Fed's gone to a golf analogy. They've sort of gone from a difficult, long uphill putt where the danger of really overshooting is not that high. You were talking about a recession, maybe even landing no recession or at least a mild recession. Now they're in the opposite position. Now they've got a pretty steep downhill putt and they're really trying to figure out how hard do I have to tap this ball to get it where I want to be, but not have it go right off the green, which is the danger here. And that's a really big difference that I think that the Fed is going to struggle with here going forward. It is a much trickier situation as to how much more they're going to raise rates, whether they're going to raise rates any more at all, and what the implications of that are for inflation on the one hand and for the banking system and onwards to the economy on the other.
I mean, in some ways, Omar, it's kind of, well, let's go to the survey question first before we ask Omar's comment. Brent crude oil averaged at close to $81 a barrel in Q1. What will it average in Q2? closer to 85 or above, that's the plus mark, closer to 80, closer to 75, or closer to $70 minus, as in below 70. This is on the average for Q2. Where do you think the money falls on the quarter coming? Omar, on that point, vis-a-vis the sort of the choices, the Fed was already near the end of its tightening cycle again before this banking crisis happened. It was already going to be one or two more moves as the market were forecasting. So I don't think that's necessarily something different here. I think the question is now about how quickly, or will, the big question was that the Fed was already near the end of its tightening, and then it was going to pause and hold at this elevated place for a long period. Now it's the question is the market signaling how quick are they going to come off the hold and start cutting. That's the narrative. So that's what the markets are saying. Omar and all of his buddies in the financial markets who price all of these things, they're telling us a quick come off. So let me hear your views on that.
No, I think basically it's like the war in Ukraine. Like it's like 180 degrees, right? So I think not just like what Bora was saying, 70s and whatever. I say big wolf, giant wolf, absolutely huge. Wolf, right? So the Fed, I mean, this is fantasy land. So the stuff that they were going to hold and cut, and then come the end of this year, it's going to cut, and the average in 2024 is going to be 2%. I mean, this is just la la land, right? So the Fed started trying to withdraw liquidity from the market in March 2022, right? If you look at the market now, it's got the same, if not more liquidity than when they started, even after they've raised interest rates. Why? Because in the last week, 2 weeks, they've injected at least $300 billion to kind of try and stabilize these banks. So it's complete fantasy. So it's great that we have that kind of sentiment out there, because it allows us basically to take position and make money. To be honest with you, I love the fact that people are still like, everything's going to be okay. The Fed is going to put, and then it's going to be fine. What's coming, I think, is going to be quite interesting. So the bottom line is the Fed are not just in a bind; they're completely stuffed. They have interest rates at 5% and they haven't withdrawn any liquidity. So the choice is quite simple: massive recession, massive hyperinflation, right? That's the choice. If you ask me, when you have hyperinflation, nobody wins. The people in power controlling the levers of power, they don't win, because everybody loses. If you have a massive recession, then the people in power win. So I'm praying that you get a massive recession and you don't get hyperinflation, because I think in that way certain people win and other people and a lot of people lose. But I mean we're extremely negative. We're negative everything, negative banks, negative equity, negative oil, negative everything. And I think the longer that this sentiment, there's no kind of purity. If you come and you tell me I'm going to get a punch in the face now, I can get ready for it, right? I can get ready. I'll be like, okay, I'm expecting it.
As Mike Tyson once said, everybody has a plan until they get punched in the face.
But you get ready for it, then you get a punch, and it's fine. But the market right now is walking like nothing is wrong. When they get this punch in the face, they're going to be so.
How can so many smart people like you, Omar, who have gone to Imperial College and having, very, very educated, be so in such a slumber? I would say. I mean, this isn't just a few people, right? You're talking about the full brains of Wall Street and the City of London and God knows how many other places that set these. Tokyo. Since
2008, the West has done that. Since 2000, the West has only expanded their economies by expanding credit and printing money. That's it. I mean, and there were books coming out that, free, printing money is not going to make any difference. The new economics say, massive debt makes no difference. Print money makes no difference. Well, that's la la land. And you're going to be introduced, I think the markets are going to be introduced to the real world, right? To basically where finance or financial instruments don't have value. What's the value in having basically take the whatever it is, any kind of, if it's a piece of steel, you can make something with it. If it's a piece of paper, it's not very useful. So I think the world will tilt that way for a while. We've gone so much towards financialization of everything, where basically the financial markets in the US are like 3, 4, 5, 10 times the size of the real market. That cannot persist. You cannot live on paper and speculation and wishes and fluff. It's going to go away. The only question is it tomorrow, next week, next month, or next year? But somebody's going to come, like Bora was saying, there's going to be a massive readjustment. And then people better get used to it, because what happens when they're not is what we're seeing now in Paris, what we're going to see in Germany, what we saw in the UK, and what we're seeing in Israel. People are pissed off. They're going to get even more pissed off. You wait and see.
Bora, bringing it back to the immediate sense of this week, which is what we try to do occasionally on this podcast while we wander into other corridors. But ultimately, oil is up, showing the markets opening in Asia this morning, showing a relatively sober sense of things. Maybe they're sleepwalking, maybe not. But in the immediate sense, where do you see the direction of travel? Do you think we are in the immediate sense close to another adjustment, or expecting more of the same this week?
I think we're at in a more of the same zone for some time. As I said, we know the cure to inflation is a sort of a Volcker moment when the rates go above the rate of inflation, but the markets are betting that we will not do that won't be the policy, that we'll continue to have kind of more kicking the can down the road. But I think Omar's right. There will be a point where that stops. There's a retrenchment, and let's be optimistic. There will come an 80s moment again after the early 80s moment, which was really hard, a kind of a 83, 84, rebuilding the world together, hopefully. Somehow America and China not having a hot war, because they see how damaging that has been in Europe, and we have a new international regime, because people need resources, oil, metals, plastics to live, right? And that needs to be priced in a transparent way, not with this sort of funny money that has been flooding the world. And I think the moment will come when we rebuild and in an optimistic mind frame, but we're not there yet, certainly.
Bill, I know you're back in the UAE, having just recently come from the US. I'm just wondering, from a US point of view, again, the macro signals there. I mean, the Fed is tightening because the economy is too strong. There's too much employment. There's too much wage rises. From a purely immediate macro sense, the U.S. economy looks like it's on a move in which, rates below the rate of interest rates, as he says, Boris mentioned, not crossing the Rubicon of the inflation rate. The U.S. economy will continue to soar ahead. Does it seem that way from in the U.S.?
Well, that perception's changed a lot in the last little bit. The Fed was raising rates because inflation was too high and they were trying to bring it down. There was a bit of fantasizing going on that somehow that was going to miraculously happen without employment falling or without the economy contracting. That probably wasn't ever going to be the case, but I don't think anybody anticipated the threat of a full-on banking crisis. Again,
I think that comes back to my first point, though. The reason this banking crisis happened because some numbskuts in Silicon Valley Bank didn't diversify their investment portfolio, not because of a million other reasons that the Western world has reached its end point. There might be other reasons for that, but the SVB bankers screwed up.
Well, combined with the rapid withdrawal, which then forced all those unrealized losses that Omar is talking about to come to the fore. Now,
if Peter Thiel wasn't your favorite person in the world before this started, he certainly is the doo-doo on the bottom of my shoe now.
But that does not have to happen serially in a kind of, wildfire through the mid-sized banking sector. It can, if they can prevent that sort of thing from happening, there can be a much longer term workout. Maybe it does reach a cliff eventually, as Omar's been telling us, but that's not inevitable.
Well, I think it is. It's sort of the point I was trying to get to today in the terms of some of the sense of, is there a consistent narrative here as to why this banking crisis is happening? Credit Suisse was already in doo-doo land long before this banking crisis came along. SVP's portfolio was already in nonsense. Risk management, no risk management. Apparently, there was no chief risk officer at SVB.
No. If you're holding Credit Suisse or SVB, the risks got too great. If you have a bank account or a deposit at SVB or Credit Suisse, the risk got too great. Who's going to move first? Who's going to take their money out? Is there going to be any money left for me? Risk got too big. That's what changed.
Well, on that note, we're going to have to wrap it up here because the risk of going over already 6 minutes, which we've never done before, actually, I don't think. We pride ourselves in our timekeeping here at the Daily Energy Markets Podcast. Omar, as always, awesome. Thank you. Bora from London, I really appreciate it. Hopefully the light's coming your way at the moment. Always a lovely place to be in the world when the springtime comes. Enjoy it. Bill Spindle, welcome back to the UAE. Look forward to our lunch today and catch up with everybody through the week at 10:30 UAE time. All the best. Thank you.
Thanks all.